Okay, for the second part, I'd like to introduce our two speakers. The first is Ofer Lion. He's a tax partner at Seyfarth Shaw. He represents nonprofits and tax-exempt organizations. Some of the areas he covers include executive compensation, unrelated business income, lobbying, and tax-exempt bonds. He also co-chairs the Exempt Organizations Committee of the American Bar Association for the last 8 years. Secondly is Lior Temkin. He's a tax partner with Singer Lewak. He leads the tax group here in the Los Angeles and Woodland Hills offices, and he also leads the nonprofit industry group. At this point, I'll turn it over to you guys.
Hi, good morning, everyone. It's still morning. I think everyone's 2 coffees deep, so I think we're ready to go here. Oh, this is already not working. There we go. So I think what we're going to try to cover is a lot of the more common fiduciary issues, nonprofit governance issues, and sort of related problems that I see kind of cropping up on a regular basis, and then I know Lior sees probably on an even more regular basis, once a year per customer. Sure. Maybe speak up or turn it up. There's someone back there. There it is. So I guess one quick question, just so I know where to focus it, is if you're an accountant, raise your hands. Okay. Accountants? Everyone? Yes. Almost everyone. Any lawyers? Well, then I'll save my jokes for later. So fiduciary duties, we'll kind of walk through pretty quickly. I think most folks are aware of what this means. Better? I'll just start yelling if need be. But the fiduciary duties that I end up looking at, care, loyalty, good faith, and obedience, these kind of come up in a corporate statute that kind of, in a single sentence, the backup.
Oh, I think that works.
All right. So the typical statute kind of wraps all these fiduciary duties, which come from centuries of case law, sort of English case law you'll see coming up in these areas, as well as our favorite from Delaware. But good faith, the best interest of the corporation, I think everyone kind of knows the drill. The 2 ways these break down are the duties of loyalty, good faith, and obedience is really when there are conflicts. Conflicts between the directors and the entity, the nonprofit itself. One of them that I see pretty regularly is the corporate opportunities rule, which is you're not allowed to take corporate opportunities away from the nonprofit that you're a director for. So if there's some kind of business deal or something of the sort, you shouldn't sort of step away from the board and grab it on a personal basis. But it kind of works the other way around when you're thinking about conflicts. With accountants, I often get the question, hey, we have a great accountant on our board. Can we hire them to do, the 990 or something? And it's not the end of the world, but I think that the basic rule is please don't join a nonprofit to try to get business from that nonprofit. It comes up in a variety of ways. Hey, I have this piece of real property. I want to lease it to the nonprofit that I sit on the board of. Can I do that? How does that work? There are ways to get through those kind of self-dealing transactions, but it's just, from the outset, it's not the greatest idea in the world. The duty of care, and I'll sort of get to a case where this comes up, but the duty of care is really, you got to pay attention. You have to know what's going on, be aware of the financial rules, and this is sort of directed at the directors. They are the overseers of the nonprofits, and the accountants are really sort of, I think, helping them with this process. So you're working with management, you're putting together the numbers, you're reviewing their financial controls, but ultimately the report's got to go up to the audit committee or the full board, and they're the ones who have this duty of care to be aware of what's going on with the organization. So, my sort of view of what you're doing is helping with, board training and helping them fulfill their duty of care. So they know what's going on so they can make informed judgments. If they make informed judgments that are not on a conflict sort of basis. I have this great judgment of how much you, nonprofit, should pay me for the use of my property should be as much as possible. That's the rule. But if there is a conflict, business judgment rule doesn't apply. If the directors have no idea what's going on, the business judgment rule doesn't apply. The business judgment rule is basically a way to tell the court or the judge, it's none of your business. We, the board, made a business decision. It was an informed decision. None of us were conflicted, and the courts typically are not going to step in and sort of second guess what the board did or didn't do with respect to any particular transaction. The way to see how this plays out is this case from my hometown of Pittsburgh, where the Leamington Home for the Aged was being fairly quickly run into the ground by management. The directors were not paying attention, weren't getting reports, weren't really holding meetings, and ultimately the court held the directors personally liable for over $1 million, joint and severally, and this is just a little nonprofit with one sort of elder care home, and they were tagged by the court. Most people, and we'll get to it later, volunteer directors, hard to get them to be liable for much of anything. They have a lot of statutory and other legal protections, but it is something to be aware of. And the real underlying reason was that they were unaware. And the court basically said, hey, you were supposed to be the overseers. You were supposed to know what's going on. You were supposed to have seen this coming and stopped it in its tracks, a year ago, 2 years ago. And now it's too late. It's your fault. You didn't know what was going on. And the directors were responsible. So in governance, and I think since 2006, when the new 990 came out, now over a decade old, that sort of page with questions about the governance of the organization, typically you would think, well, what business is it of the IRS of how we govern our entity? And indeed, that page from the 990 in its early draft said at the top of the page, by the way, none of this is required by law. We're just curious, in so many words, and they stripped that little tagline out of there at some point in the draft. But the IRS is worried, as is the Attorney General, and I think one good way to take a look at an organization is to sit in the seat of the IRS. Well, what are they looking at? And they'll tell you, because the IRS Governance Project check sheet, Form 14114, you can just dig it up on Google at the IRS website, and it sort of walks exactly through what an IRS auditor is going to be looking at when they're auditing your organizations or your clients. So it's good to know what they're going to be looking for, and maybe just get out in front of it and say, hey, do we do these things? And there's a lot more there than just that sort of list of 20 questions on the 990. Another one is to follow the corporate procedure set in the bylaws. This is coming up more and more. Our new Attorney General, Javier Becerra, the rumors are coming from high on that he does not take kindly to nonprofits with sort of loosey-goosey governance procedures and certainly financial controls. And I'm seeing a good bit of that in the nature of the audit letters that clients are getting from the Attorney General. They're going into way more detail and looking much more closely at the governance procedures, and that starts with the bylaws. Bylaws say here you were supposed to hold quarterly meetings at the main office. Show me the minutes. Where are they? Oh, you only held it 3 times? You missed a meeting? You're not following the bylaws. And they're sort of taking that tack with the bylaws. And that stems to the conflicts policy as well. If the bylaws sort of have a built-in conflicts policy, and there was some kind of self-dealing transaction, a director loaned money in and we paid interest, any interest, self-dealing transaction, the conflicts say you had to do X, Y, and Z to make that work, and you didn't. So following the corporate procedures in the bylaws is always been important, good governance, but it's becoming more and more of a red flag when the AG starts to dig in. What's the solution to this? I sort of take this, and you might use it, hey, there's a new Attorney General. He's not running for another office just yet, so he's actually focused on his job. every AG in California. Their typical job's to run for some other office, but I think we'll have him, 2 years. He might actually, really focus on this area. And from what I hear, he really is focused on the nonprofit sector. So I think, use that as an excuse, do some board training, make sure your organizations have a good board book. And that goes to, how do you know the directors all know the rules of the road? Well, when they came in new, someone gave them the playbook. These are our bylaws. These are our articles. This is our mission. These are, this is how we run the meetings, and this is how we do the minutes. This is the annual disclosure that you're supposed to send us back every year, saying, these areas, maybe I have a conflict with the organization. So the board book is key, and I think that training, and while you're at it, you're doing the training for new directors, you might as well, use the opportunity to do a training for the full board. Just say, hey, there's sort of new things happening. Let's take a look and revisit and make sure everyone's everyone on board is on board. The regular meetings are key. Separating the CEO from the board is a sort of tried and true piece of good governance, not always followed, and certainly not always followed in the nonprofit sector, where you often have the founder be the CEO and the chair of the board and the head of every committee on the board. Not ideal, but it happens. It can be okay. Sort of depends, but I think everyone sort of knows what that founder syndrome looks like over time. They kind of, this nonprofit is my baby, this is my whole life, and suddenly the accountants are looking at them and saying, hey, you're really treating this like it's your baby and it's your life, and all your personal expenses are coming out of the corporate credit cards. And Javier is not here to hear you laugh about that one. So some of the ways to minimize liability, our big Captain America shield. How do we shield our directors and our management, frankly, from liability, from personal liability, like the Leamington case in Pittsburgh will show you. Proper oversight, that's what the board's supposed to be doing. The audit committee is supposed to be reviewing, your work, and then the full board, the work of the audit committee. Avoiding conflicts and self-dealing. One good way is make sure there is a conflicts policy and there is a sort of annual questionnaire that goes out and people are really disclosing what their potential conflicts are. Adequate D&O insurance policies. They are very inexpensive. And every time I ask about one to a new nonprofit, oh yeah, of course we have a D&O policy. Everyone has one. And I say, okay, just for my records, why don't you send me a copy? And typically the next email back is, do you have any recommendations for providers for D&O policies, and how much do they cost? So make sure they're there, and then certainly if you are a director already on the board and thinking of leaving the board, that nice long tail on my friend there is a reminder that the tail on the insurance policy, if you are merging the thing out of existence or dissolving or doing a big spend down, at the end of the day, that insurance policy is going to end on the last day, and you want to make sure there's a tail of 2, 3, 4, 5 years out, sort of from the end point. Again, not expensive. There is this sort of bizarre trigger. Some of them will say, oh, we'll give you a 3-year tail for $4,000, but a 4-year tail will cost you $30,000. There's some, the insurance companies have some magic number, and I just take the longest, cheapest version, and right before that elevator hits, that's what I recommend you pick up. Indemnification, this one is sort of along with my test for, do we need new bylaws? Do we need to update the bylaws? But one thing I'll look for is the word telegraph. If I see it, it's time. The other kind of marker is the indemnification will say, that this corporation may indemnify the directors to the fullest extent of the law, et cetera, et cetera. Well, that may is permissive, it's not mandatory. And by the time you need to be indemnified, it's too late. You're going to have to go back to the board and say, oh, I messed up. Can you actually indemnify me? And that may means, oh, it's got to go back to the board, and they have to decide now whether to do it or not. What you really want to see is the board shall. And that difference does come up in the courts. And if it's permissive, you will probably lose if you're the director who did something wrong, because it's going to be too late. The board's not going to decide to go ahead and indemnify you at that point. You want to make sure those are mandatory. I'll kind of skip through this next section a bit. I think everyone's more or less aware that the directors of nonprofits, and in particular volunteer directors of nonprofits, have a lot of statutory and judicial protections from liability. One key, though, going back to the D&O policy is, okay, you have a D&O policy. Well, what about your general liability policy? Do you have one? And I get sort of the handheld. Let's try this guy. Here. All right. So the insurance policy. After I get them the D&O policy, do you have a general liability policy? And less often do I get the question back, do you have any recommendations for that? Typically they do have it. And you just want to make sure that it is in a high enough amount, the total coverage, that it triggers the California statutory protection scheme. So it's either 500,000 or $1 million, depending on the gross revenues of the entity, but only if the nonprofit carries enough insurance coverage, then those statutory protections kick in. And then the federal law, Federal Volunteer Protection Act, has the same trigger. It basically says this statute will protect the volunteer directors and management so long as the nonprofit meets any threshold that state law requires for extra statutory protections for volunteer directors. So if you have the right amount, you get the California protection, and then that also triggers the federal protection. So you just need to make sure that they have not only the D&O policy, but a general liability policy so that they do have these extra statutory protections. What makes those policies rather inexpensive is the insurance companies know about this statutory regime, so that they know if I just sell you the $1 million policy, you're never going to need it because you're covered by all these things, but you have to have the policy. So take a look, make sure that not only do they tell you, yes, we have insurance, but just for my records, show me a copy and let's take a look. Conflict of interest, again, this is sort of the big deal. This is what the Attorney General looks for. This is the kind of thing that gets you into the newspaper when Lucky Strike hires the doctor and the doctor says, oh yeah, they're healthy because they're toasted. So common conflicts of interest, and this is what Lior and I will end up sort of discussing and debating. You've probably all seen some of these, and I'll wait till the dreaded slide 13 is next. So these are kind of some of the easier ones. Co-investing, that's typically when you have a private foundation kind of mixed into a family office. So the big family foundation, they've got a family office. The family office kind of runs everyone's life. It's fantastic. I was not born into one of these families, but apparently, they handle the mortgage and your insurance and do your taxes and everything else. And if you have a business, they handle, the comings and goings of your business and, the janitor and landscaping, everything's kind of taken care of. The family office runs everything. They also handle the investing for the family, for all this sort of separate businesses. And typically they'll form a fund. And that fund will sort of do the investing with, all the pieces coming into the fund, and the fund can get into these, big, private equity deals where there are minimum thresholds. You have to invest at least $1 million, so normal people can't get into them, but they're great returns, and that's sort of how they do it. And of course, the private foundation is invited to put all of its endowment into the fund so that it's co-invested along with all the family business investments, and that's sort of inherently self-dealing. You just did a little buy and sell of a limited partnership interest with a nonprofit private foundation and disqualified persons. There are ways to deal with it, but it's just something, be aware and take a look. It's very common, and typically it's done the wrong way.
Right. And we see it a lot with private foundations that go in, you got to keep a certain minimums of percentages, and so we always encourage our clients, as you guys know, when you guys are going into certain things like that, to give us a call and just make sure that hey, is this okay? Is this, what's the limit? How much? How do we do this? And we'll be able to guide you through that.
So cost sharing is another one, and it's very different rules between private foundations and nonprofits. The private foundation is basically banned from paying any rents to disqualified persons. The only thing it can really pay for is compensation for professional services, management type services. So landscaping, janitorial, that's out. That's self-dealing. I don't know exactly what is professional management type work, but you can sort of think of it as white collar. I don't know, maybe that's how the exception got put into place, but I have seen the sort of private foundation had a real estate portfolio, and they hired, cousin Bob to do the janitorial and the landscaping, and that was self-dealing and sort of got them in some hot water.
Yeah, we had a situation where a prospective client was a private foundation that was going to rent a small office space, about 5,000 square feet. And when I say small, it's because the matriarch or the family, the guy that runs the private foundation, owned this piece of property. The private foundation was running everything through the LA office, but he lived in San Luis Obispo and wanted to use one of his properties that's over there for him, to use when he's up there and as part of the private foundation. But 5,000 square feet for one individual, and by the way, they would pay him $20,000 a month. I said thank you, but no thank you. We passed on this client because they also passed on me because I was very adamant about not doing something like that. Just you would be able to, you would trigger some really bad things for the private foundations. It's not necessary. So good luck to the other accountant that signed off on this, or the attorney, which was not you.
5,000 feet sounds reasonable for one individual. Quality office space.
Yes.
I'm sure the same person was collecting director fees.
Probably.
Director fees are, I'd say, fairly common in private foundations, especially when it becomes a sort of not the family anymore kind of foundation. Just a big grant-making entity. You need investment managers and the like on the board. You'll often see director fees being paid by these large sort of ex-hospital foundations. Nonprofit hospital gets sold out to private hands. The sales proceeds just end up in this now shell of a nonprofit that used to have a hospital. What do? They invest the money and they make grants out and they do whatever they're going to do, but there's no one really to sort of jump on there and volunteer to do it. So they pay $20,000, $25,000, $30,000 a year in director fees. In the sort of public charity space, that's becoming somewhat common in the healthcare space. So a lot of the healthcare boards are struggling to get, sort of high quality directors who know the sort of, data privacy and healthcare regulatory issues. And again, the investment manager types, they're competing with the for-profit public company boards that are doing healthcare, HealthNet, all kinds of sort of publicly traded healthcare organizations that are paying sort of public company type director fees. They're paying $200,000, $250,000 a year, and they're getting, the retired generals on their board and, financiers and the like. And the nonprofits are struggling to compete with that because people are serving on fewer boards because of all these extra layers of liability and the complexity in the healthcare space. I'm starting to see that kind of wander into some of the other nonprofit areas that are really the fee-for-services kind of organizations. They survive from program revenue. You really don't see it in the types of nonprofits that are doing fundraising. That's where you get the sort of give or get. You want to be on the board, you either give me, $100K or $500K or whatever it is, or go get it. And that'll lead into another question to come up here in a minute. But the director fees are common. the one sort of legal issues, usually when you're doing compensation for disqualified persons, for CEO, you go through this sort of process. You look at comps. You have the independent members of the board agree, oh yeah, we'll pay this person this much, and then you're set. You have this rebuttable presumption of reasonableness. You went through the right steps. It's sort of deemed reasonable until proven otherwise by the IRS. That doesn't work with director fees because there is no independent board above the board who just decided to pay themselves. So it is, you don't have that extra layer of protection. I don't know how much that really adds up to, but it's certainly something to keep in mind when your organization's talking about director fees or talking about raising the director fees, which is very common. As soon as they land, the next year they want to raise them up. So pretty common. The last one here on this list are the gifts that are subject to debt and liabilities. And a pretty common story, my family has owned this apartment building for years. I'm going to give it to your organization. Kate, I love your radio station. Here's my apartment building. It's worth $10 million, and by the way, there's $5 million in debt on it. So, it's $5 million net proceeds. If I'm a director at KCET or one of your other organizations and we do that same thing, well, they just sort of paid me $5 million for the building. I know it's worth 10, but they just paid me 5. That's a self-dealing transaction. It's also an interesting tax problem that you might want to point out to your donors. If you give me property subject to debt, it's as if we just had a deal. So the $5 million in charitable contribution deduction I get, because it's sort of a bargain sale, great, but I also have $5 million in taxable gain from that sort of relief of debt. I just handed you the debt that went with it. I've got $5 million in tax, and you can sort of see where the numbers come out. Sometimes your well-wishing donor, thinking they're going to get a nice charitable contribution deduction from this net, end up paying tax on the deal. So something to keep aware.
But what do we tell our donors? Please talk to your tax advisor before you do this, right? We don't give them any tax advice. We'd be happy to, but we don't want to because of the potential liability over here. So it's we always put on that letter, right? Please consult with your tax advisor regarding this. And so.
But in these cases, tell them twice.
Yeah.
You put it in writing once, remind them again. By the way, this asset is subject to debt. Make sure they are well aware of the tax consequences because you don't want the angry donor. You want them to give their next building to you also. So if you kind of do it right the first time, they'll either be happy about it or you won't get the building. But so be it. So this is now the almost comical slide 13 here. These are the issues. Probably Lior gets this, once a week. Personal pledges and ticketed fundraisers. So personal pledges come up all the time. Hey, I was at the $10,000 a table rubber chicken dinner, big fundraiser. I had the paddle. I waved it. I'll pay X dollars for this big gift, or I'll join your board. LACMA, I think, they're probably at $1 million. You want to join the board of LACMA? It's give or get $1 million. Okay, I'm going to sign the thing. I'm going to give or get $1 million. Thank you. And then, Lior, I have a private foundation. Can you just cut a check for the $1 million, send it over to LACMA? Is the foundation allowed to sort of satisfy my personal? I made a personal pledge, $1 million, and now I'm going to have my foundation go ahead and pay it. It looks fine. Foundation's making a grant of $1 million to LACMA. Should be okay. But it's an issue. It's something you want to look at pretty closely when you're making those personal pledges. The same kind of thing comes up in a donor-advised fund, and I actually think those are kind of an easy tool to use. I had a client recently say, we have this donor. She wants to make the contribution out of a donor-advised fund. We want her to give a pledge to us. But we don't want her to get in trouble, basically, promising to satisfy her personal pledge and then calling the California Community Foundation to send a check to cover that amount. And we basically just said, well, why don't we just write the pledge? I pledge to advise the California Community Foundation to send you, the zoo, $50,000. That's all I'm pledging to do, is make that piece of advice. That's all I did, and that's exactly what I'll do. So we'll sign it. And the only issue really was, is the zoo's capital campaign team going to accept that and say, okay, we're going to raise our little thermometer up by the 50,000? Oh, no doubt. There was no problem at all. So that's sort of how we solved it through a donor advised fund. But you can do something similar with the private foundation. Just make that pledge on behalf of the foundation and make it clear from day one that that's what's going on.
Yeah, I had a client actually a couple weeks ago say that a board member that every year there's a membership that they have to pay, and they wrote in the letter, the membership letter, and they sent it in, and then they received a check from their donor advice fund, and that's a big no-no. You got to really be careful with that. And luckily for us, they called us before they accepted the check, and we had to write an email to the it was a mayor of a certain city around here, and that we had to write this to, and it was you gotta just really be careful. And every year up until this year, they paid it directly from their own checking account, and this year I guess they set up a donor advice fund, and they decided to use those funds. So we had to send back the check, and they had to send a personal check directly because of the specific, it was for a membership. It wasn't for just an ordinary type of a pledge that we could have worked it out.
So in addition to the sort of issue with personal pledges being satisfied through a private foundation or through donor advised funds, another common question that comes up is back to my rubber chicken accusation of these big benefits that every nonprofit has at least once a year. The $10,000 table I mentioned. Okay, we are family foundation. We are going to support this charity. We'll take a $10,000 table. There's 8 seats, and I'm going to bring my spouse and a couple friends. It'll be great. It's a big show, there's an open bar, it's going to be fun. And we say, well, the foundation's going to pay the $10,000, obviously. And we say, well, you're getting a lot of personal benefit, you're kind of bringing the family and the friends. And they say, don't worry, how much does a rubber chicken cost? Good question. They send you back, thank you for purchasing the $10,000 table. In exchange, we provided you with a meal worth $100. It's, I think, $10 a head. So you have a contribution of $9,900. Thank you. Talk to your tax advisors. Maybe you can get a deduction. Say, well, I'll just write the check for the $100 personally, and you, foundation, will write the $9,900 check for the rest. That's the contribution. Does that work? And the answer is no. You cannot bifurcate those two things. The IRS very clearly does not like that. They don't buy it. And so that's not a good argument to make. I think the better argument is to say, first of all, I put my spouse on the board with me. The kids are on the junior board that I established about 2 days prior to my writing that check. And the friends are potential new donors for this organization that the foundation is supporting, and they're here to see the song and dance. But it's every rubber chicken dinner comes with the pitch. This is the wonderful work this nonprofit does. Send us money, join our committee. Be in the gang going forward. So that's kind of the better position to take, is the foundation is doing this, and everyone at that table is there on foundation business of one form or another.
We actually have some clients that reimburse the foundation, even though it's not necessary, because we go through the whole list of questions. Who'd you bring? And it's usually the people from the board, or their spouses, but they're there on business, and they still reimburse the foundation. It's a more conservative way of doing it, but I appreciate that as an accountant, as a person signing the return. It's something that that you may want to think about. Is it necessary? Not always, as long as you document it and you say why these specific individuals were in attendance with you.
Yeah, so, when I get the question in advance and the options there, and they say, can I write this $10,000 check from the foundation? And if I say, well, why don't you just write that one personally, you're going to get the deduction, right? Hopefully. It won't count towards the 5% distribution requirement from the foundation, but they'll find some other way to get rid of that money, I'm sure. So that's the better answer. But I think if you're already, they already bought the ticket, and you got to come up with the rationale. I think the way to do it is the business purpose for everyone at the table. But even better than that is sort of think through in advance and let them know, hey, if you're doing this on a regular basis, and there are certain communities of people, this is sort of their social life to go to these things, and they're doing this monthly. Make sure they're doing it right, whether they're just paying it directly from personal accounts or they are very cognizant of who they're supposed to be inviting and why they're supposed to be there. Again, the Attorney General, and this is not Senator Harris, nor is it Javier Becerra. That is Big Brother watching you, and that's the Big Brother watching the board. So you get the board of directors are sort of the overseers and fiduciaries over the nonprofits. Well, who's watching the watchers? That's the AG and the IRS, and sometimes the Franchise Tax Board. They pop their heads up every now and again. I think that one big current development that I wanted to mention among the attorneys general generally, there are 50. There are some 40 states that have some kind of charitable solicitation registration requirements of one form or another, and they're all different. So you probably know if your charity is doing fundraising here locally, they're probably registered in California, they're all set. But when you start doing internet-based fundraising, which hopefully you are, fine, you can say, well, that's passive. We have a donate here button. We're not going into other states and soliciting there. Okay, well, how big is your distribution list via email? And how do you know half those people haven't moved out of California by now, and you're specifically targeting people who live in New York or Massachusetts or New Jersey or one of the many states, 40, that have some kind of registration requirement? I typically send people elsewhere and say, hey, you're doing a lot of solicitation activity. If it's in 1, 2, or 3 states, maybe just register there. But as they get bigger and more sophisticated in their fundraising campaigns, I say, you've really got to do a 50-state registration, by which I mean a 40-state registration for now. There could be another one tomorrow, but they change all the time. And there's a couple firms out there who just do this as a matter of course. They've got 5 lawyers and 50 paralegals. It's just an annual fee. It's $7,000 to $12,000 or $15,000, and that's for the initial setup and the ongoing annual maintenance of these registration requirements. Great. That's where I send my clients. The AGs on their side of it, typically they just want their fees, their annual fees, and they are all sort of working on a single multi-state portal to be able to make this a lot easier and to drive those firms that I send the work to out of business entirely. Slow going, but every time I hear from them, it's always that they're about 8-9 months out from this thing launching. So keep a lookout. In the meantime, think about whether your clients should be registered in all 50 states and whether they're really engaging in that level of fundraising activity.
Right. We had a client, or we still have a client that went on a talk show and to introduce a new program that they're doing. That they were already registered in a bunch of these states, but this talk show was going to be in every single state. Even though I think most people don't even watch that show. So on as a safe bet, what we made sure was that they were registered in all those states, and made sure that it's usually these filings are actually done by attorneys, even the annual registration, not just the initial registration, but there are a few, like Ofer said, really good attorneys that do that. One of them, I think, is in Beverly Hills. Another one is somewhere in Kansas City that we use. But anyways, it's important, and you got to be careful because some organizations will get hammered because of that. And we had one actually organization that received $1,000 a year in Utah, or from a donor in Utah, and their attorney general jumped on it. I don't know how they figured it out, but from that $1,000 donation, they received a nice little letter from them. And at the end of the day, they concluded that it's not worth it for that $1,000 that they would get every year. So they told the donor that there's a great organization in Utah that they could contribute to instead of sending it because of just the additional cost and yeah. So.
Yeah. So before we go on to the next section, the reporting of all these terrible things that happen and how you have to report, just wanted to go back to I guess this is the right slide. Big Brother's watching, great. The Attorney General is out there. Javier Becerra cares about the intricacies of the governance and the financial controls. How do they find out what's going on? We'll get to the reporting in a minute, but I think from my perspective, the way I see this happening is if you want to keep your clients, your organizations out of trouble, there's always this sort of the front page test. Is what you're doing going to look good on the front page at the LA Times or on the Orange County Register or wherever the entity is? So that's just sort of the smell test for what's going on. It's also the main trigger for audits. Some organization doesn't like you, you're a rival, you have unionized labor, there's a union dispute coming up. They're the ones digging through your 990s. They're the ones who know what's going on the inside. They're the ones kind of making quiet calls to the Attorney General, to the press. That sort of negative article will result in a letter from the AG asking for more information. So we're not telling you how we knew and why we came to you, but everyone kind of knows, and you kind of go through it in that fashion. So the Big Brother is watching you. It's sort of like it's the East Germany sort of feeders to them. Who's going to know? How do they find out? If there is bad press, you can almost expect an Attorney General letter to follow in the months subsequent. The IRS and the Attorney General do have an information exchange. It's good old California and New York, I think, are the only ones who signed up for that. Hawaii as well, sorry, Hawaii. But that's sort of what you're looking for. And so I think, at the outset, you kind of think, well, first page test, smell test, does this stuff going to look okay in the paper? Is the way we run our finances going to look good on the audit? Will we be able to answer the questions when they look at our company credit card statements and it has sort of fees for this and that? Can we explain the business purpose for each? When we see petty cash withdrawals kind of going on a regular basis, it just says petty cash, petty cash, petty cash. Well, what were those for? Does anyone know? Does anyone have records? The accountable plan rules. These are the kind of things that our Big Brother here is watching for. And that's how they find out. There's sort of weaknesses that the disgruntled employee picks up on, that the union rep hears about, that the media picks up on. Those are the issues. That's how it comes up and lands on my desk.
Right.
And I think one really key piece is they're also, the Attorney General, whoever's auditing, they're going to look at the 990s. They're going to look at the RRF1s that were filed with the Attorney General. And the two things you're telling, here's a bunch of information, and here's here's how we reported our goings on prior to this audit starting. And the two hopefully match up. Typically they do not. Those are the kind of the problem children. But that's I think the key is when you're doing these sort of audited financials, when you're preparing the 990s, this is sort of you being this guy. Big Brother, but you're sort of helping them and prepping them. I sort of see it as you're doing audit prep.
Right, it's a self-auditing tool, basically, the new 990. But we used to just be scared of being on the LA Times or the OC register or whoever. Now it's even TMZ. One of my clients was on TMZ for something that happened, and it all started from a rival, an individual that didn't like this guy, and they did some expose on it, and TMZ caught onto it, and then 2 weeks later, it was that fast. 2 weeks later, I got the notice, the IRS notice. Now, the investigation came out that everything was fine, him personally, but then also the foundation. We just got the notice last week saying it's a no change because everything was fine. But we just have to be careful about everything that we do. Everybody's got cell phone cameras. You actually use the cell phone less for making calls nowadays and just taking pictures and sending it. So anyway, we got to be really careful about what we do. So now we're going to go real quick over certain disclosures and items on the 990, and then also on the RRF1 that goes to the Attorney General. Dealing with diversion of assets. Okay, so it's interesting how the 990 has a different definition of what the RRF1 really says. Diversion of assets, let's just call it what it is, okay? Theft or misuse of assets, let's just deal with it. What is significance for the 990? The 990 specifically says if it's lesser of $250,000 or 5% of the organization's gross receipts or 5% of the organization's total assets. Well, what do you do when it's less than that? Okay, do you want to be in the news for something like this? Probably not, okay? However, it really depends on how the board and the attorneys and us, how do we feel about the situation? You also need to make sure that you actually disclose as to what has been done to make sure that the organization does not go through this again, hopefully, okay? So on the 990, these are the requirements. But does anybody know what the dollar threshold is for the RRF1? $1. Why? Because the Attorney General is basically the overseer, just like Ofer says. Okay? We report to the Attorney General. They are the owners of the nonprofit organization. So that's why they want to know. Now, is this going to be out in the open? No, it goes directly to the Attorney General. And they may, depending on what you put in there, and later on we'll go over certain disclosures that need to be included in there. But if you put it on the 990, anybody could see it if they go on GuideStar. So, in my opinion, depending on the situation, it's always, and you guys already know this, more is always better. The more that we disclose, even if it doesn't meet the threshold, okay, it's better that we tell the story rather than the LA Times or rather than other people, pointing it out and just disclosing it to everybody.
It's also the only way to get that clock ticking on the statute of limitations. If you didn't disclose it, it's that clock isn't moving forward. If you make the disclosure, you file this in the 990, 3 years later, that stuff is wiped from the slate clean. But if you don't disclose it, that's not true.
Right. And depending on if the individual is a disqualified individual, an officer, a director, somebody that is really an interested person, there may also be additional disclosures on Schedule L, which is dealing with inurement, okay, or excess benefits. So we got to really be careful with that. You may not meet the requirement to disclose it regularly on Schedule O, the oh by the way schedule, guys, right? But we want to disclose it, I think. All right, so over here, I know it's kind of small, but you guys are going to get this. Hear me now? Okay, I'll just be a little bit louder. You guys will get this presentation, and you'll see the disclosure. We worked on this with a client and their attorneys, and it was something really bad that happened with the organization, as you can read in the description. However, we made sure that this was disclosed right away. Okay, we actually also put that on the organization's website, because the 990 is not filed until later on in the year, right? And it could be a year from when this situation, or even longer, when this situation actually happened. But because of all the steps that the organization took, okay, I felt very comfortable with this. And it was also in the news, so we wanted to put that on the organization's website right away, so everybody is aware of what's going on. You disclose this information also to the Attorney General right away. It was something that was in the news, and we really wanted for us to bring it out. It was our story. This is what we're doing, and here are the steps to make sure that it doesn't happen again. Okay?
I think, this footnote is worth the effort. This goes in the Schedule O. It's probably roughly similar to the text of the letter that went to the Attorney General. But again, the Attorney General threshold, $1, diversion of charitable assets. It just sounds friendlier. Mm-hmm. It's like summer vacation. But the $250,000 threshold to the IRS, different story, different number. Another number to keep in mind is $300,000. That is the threshold for the major fraud unit here in LA County to take over the investigation. And that's when, I don't know who this was, but when I deal with this kind of issues, when you creep over that 300K mark, you will dutifully hear from the AG saying, thank you for informing us. Please give notice to the district attorney. And then you send them a copy. Here, DA, here's a copy of the letter we sent to the AG. And the DA basically says, that's great, but I see it's over 300K. Send it to this person at the major fraud unit. They look at it, and guess what? You just handed them a nice little win. You handed them the full pack. You did a forensic audit. You did a full investigation. You kind of named names. Everything's in there for all the world to see. That's the disclosure. The names are missing here. And should be from the 990, but when you send the AG the notice, that sort of trickle down, hey, send a copy here, send a copy here, send a copy here, eventually gets the major fraud unit, and you did all their work for them already. You handed them a clean, nice case, they take it in, they file it with the court, they get a pretty quick and easy guilty verdict because all the evidence is there, and someone's going to jail. But yeah, 300K is another number to keep close to the chest.
Yeah, definitely. So as you can see, for the California RF1, these are the items that need to be disclosed. Hopefully, we'll never have that discussion, right? Good. But these are the items that we really need to disclose on the RF1. Remember, that's $1. Something happens, $1. Hopefully, it's also disclosed in your minutes, and so these are the items that need to be disclosed. For private foundations, real quick, Ofer already talked about this, the self-dealing issues. Here you'll see a few of the exceptions. Okay, lending of money by the disqualified person to the private foundation, if interest, free. The furnishing of goods, services, all that without charge. You'll see these are some of the items that are okay. We're always going to have some gray issues. We're going to have some, that are not so cut clear, but we hope that we get the phone calls from you guys before, and most of the times we do, and it's a lot easier to set it up early instead of having to clean it up later. For the 990 disclosures on Schedule L Part 1, which is the excess benefit transactions, really got to be careful with that. That's additional compensation. And this part of the 990 is open for public inspection. Okay, so it'll be out there. Part 3, this is very common when you have certain people that are interested parties that their family members are compensated as well. So is it a bad thing? No. Okay, just as long as it's reasonable and we properly disclose it, should be okay. Not a big deal. And then, business transactions involving interested persons. So I'll just say I am renting some space from somebody that sits on the board. As long as it's an arm's length, I'm okay with that. As long as, it's voted on and the attorneys bless it as well, as long as the board is aware of all that information, it shouldn't be a problem. We've had that, and there are certain disclosures that we need to disclose over here. Again, on the 990 on Schedule L, you have certain limitations. If you reach a certain amount, whether it's $100,000 or more, if it's multiple transactions, or if it's one transaction and it's over $10,000 specifically regarding these types of transactions. Even if you don't meet it, meaning that, let's just say on a monthly basis, we pay $8,000. Okay, so it's $96,000 a year for rent from a board member. So we didn't meet that, $100,000 mark. I would recommend to you guys that we do disclose it. Why? Well, one, I think it's better to show more and to show that you guys have gone through the whole process of approving that type of transaction. And two, again, with the RF1. The RF1, you have to disclose it anyways. It doesn't matter if it's $1, okay, or $100,000. You have to disclose it. And these are the requirements of what needs to be disclosed. Hopefully, you guys disclosed it in your minutes. It was approved. All that good stuff, right? Yes? Yes? Good. So, again, because we're already doing it for the RF1, and it's better that it comes out of the organization itself instead of somebody reading somehow, getting that information from the general public or to the general public, and then you'll be on TMZ, just like one of my clients.
I think we got about 3 minutes left, then we'll turn it over to questions. I think I just want to, since I have all the accountants in the room, you guys kind of cover all of LA County's nonprofits.
Oh, the CFOs and the accountants in-house.
The financial controls. So I'll give you two little stories of why this is important. The personal expenses getting paid out of the credit cards. There's got to be some kind of check on what's getting spent, and someone's got to be paying attention. Ultimately, you, I guess, can then deal with it. So I would just sort of stress to the organizations that this is a big issue. Jerry Brown was running for governor. Kamala Harris was running for Senate. Javier Becerra is sitting around doing his job right now. And so I've literally seen a big pickup in the number of audits happening of nonprofits, and it is that kind of little issue that they're looking for. So the two examples I like to give, my major fraud embezzlement case that led to the major fraud unit's quick little win, really stemmed from someone on the board noticing an expense for a house call by a veterinarian for the executive director's cat. It was just kind of slipped in there, and no one really noticed for years, but it was, $300 some. And that eventually led to some further digging, and then to a sort of deeper internal kind of, forensic level investigation, and these sort of reports to the AG, et cetera. That's what sunk that ship. The other interesting one is the Getty Museum. Getty Museum had a guy running the place who was making $1 million. I mean, it's the biggest charity in California, I think, still. Making about $1 million a year, got the company car, was a nice Porsche Cayenne that he sent back because they got the one that didn't have the bigger sunroof. None of this was a problem. The problem that came up and that sunk his ship was the $200 shipping bill, because I guess it was found that he brought his wife with him to Italy and then to Germany to look at some other museums, and that apparently spousal travel they kind of overlooked. All right, they're kind of a team, fine. But it was raining in Hamburg, and she called someone at the Getty and said, hey, someone has to send me my favorite umbrella because it's raining, and it's raining now, so they shipped her umbrella to her overnight. That shipping bill was about $200, and that little line item was what made the papers, what launched the investigation, and what led to eventually the AG basically saying, "Look, we're not going to ask you for any money back, but you're out, and you're out for life. You cannot serve on another board in California ever," and they basically turned over the entire board. So it was, your favorite umbrella is not that important. They probably, it's Europe. They have umbrellas there also. But yeah, those little kind of slips in the expense reports and the sort of use of charitable assets are what kind of kills the baby. I don't know what that expression is, but anyway,
Yeah.
Any questions from it?
You talked a lot about all the implications that the board has to approve, and generally, I think that if it's fraud, that their directors and officers liability won't cover that; they'll be liable, and you've got all these other things in place. I mean, the CFO would be responsible for reporting these things to the board, but yet they report to the CEO. Does the CEO ever get charged with any of that? I mean, they're an employee, so they can't get any kind of civil liability, but are there criminal kind of things that they're doing stuff that they shouldn't be doing, that the board doesn't know about, or they have that? The board's giving them, is there any kind of criminal association with any of this?
To the CEO.
Yeah.
Yeah, I mean my house call with the vet for the cat, that was the executive director of a nonprofit, and that was clear criminal liability. It was also civil liability. I think you basically turn it over to the insurance company at that point because the organization had coverage for theft, and that's what happened. And
It doesn't seem like it's, I mean, yeah, it's a big thing that this person lost their ability to sit on the board, but they don't get, I mean, I don't want to say it's a risk now, but, they probably didn't need it anyway. It doesn't seem like there's really the same level of responsibility or that they're liable for a bigger.
I think those two cases are maybe not the best example of that point. But certainly the top level management, the CEO, can be held criminally and civilly liable for embezzlement. I think that was sort of a negotiated settlement with the Getty, and it was basically, look, we're not going to ask you for any money back, but one of the AG's big sticks is to say you're off the board, and a lot of times that might be the founder of the organization. And it is sort of a rude awakening to say, you just got a letter from the AG demanding that you step off of the board and have no further contact or involvement with that organization. So that's just one of their tools. That's the one they ended up with at the Getty. So that's the umbrella got you, kicked off. No further liability. The house call by the vet, jail time and civil penalty, and that was the insurance company kind of paid them the nonprofit back, and then you hand over your claim to the insurance company, and they can try to squeeze blood from a stone if there's any money there at all, but usually there isn't, and they just say chalk it up and move on.
The nonprofit suffers, but the individual responsible doesn't.
Not in this case. The nonprofit was made whole by the insurance coverage, and the executive director went to jail. So
We have time for one more question.
in the back, because you're furthest away.
What triggers the enforcement activity of the major fraud office, and how does that differ from the AG's perspective?
Yeah, the question was what triggers sort of enforcement action by the major fraud unit versus the Attorney General. And the Attorney General is really focused on the nonprofit sector. The major fraud unit is just sort of a general sort of white-collar crime investigatory unit. And so, typically it's not going to be nonprofits. It's going to be kind of shareholder-type fraud. You were selling stock in some company that was basically a closet in someone's room. That kind of, just any kind of fraud. That's kind of their version. So, armed robbery, that's a different department. But if you kind of were working at the bank and you stole the money, that's that unit's job. But the way it comes up, I think a lot of the time in the nonprofit space is, you know, first the big article comes out, then you get the letter from the Attorney General, they do the investigation, or you do it internally. You sort of discover embezzlement internally, you launch the investigation, you know, with your own group, and eventually you put together the reports. You send a letter to the AG, you fill out the RRF1 for the year properly. And a lot, you know, if you did it right, the Attorney General is going to say, hey, it looks like the board really operated well. They discovered it, they did the, you know, job they were supposed to do, they fully investigated it. You know, they went after and tried to recover as much of the charitable proceeds that were lost as possible, either through insurance claims or through, you know, civil suits. But that letter will often say, good job, board. You know, looks like we're all done here. Please give notice to the district attorney. And that's how it ends up in the major fraud units pile. And you already did all their work for them. So they're pretty quick to jump on those.
Also, for the rest of you guys that have questions, we'll be over here for a little bit, and so you guys can come up and ask questions. Okay.
Well, that's it. I want to thank all of you for coming today. The slides from the FASB speaker will be emailed out later. He's going to send an updated deck that includes that one missing slide. We have lunch provided over in the corner, and we've got the room for another hour or so, so please feel free to hang out. And if there's someone here you don't know, please go introduce yourself. Thank you.
Okay. Thanks, everyone.
Thank you.